Let's look at the fundamentals behind Merck & Company, a $335 billion pharmaceutical franchise, trading at under 19 times earnings. Every number in this deck traces back to SEC Edgar, CIK 0000310158. That valuation is worth pausing on. A 43.53% return on equity, an 18.66 times price-to-earnings ratio, and a 28.08% net margin. A combination you'd usually expect to command a premium multiple, not a modest one. Here's the full snapshot. A share price of $135.84, a market cap of $335.66 billion, book value of $16.97 per share, and diluted earnings per share of $7.28. 6 numbers that anchor everything else in this deck. Profitability is where the story sharpens. Return on equity of 43.53% is more than 3 times return on assets at 14.06%, a sign that leverage is amplifying strong returns without doing the heavy lifting on its own. The balance sheet supports that read. $6.85 billion in cash against $18.1 billion in long-term debt, and a conservative 0.43 times debt-to-equity ratio. Plenty of room for R&D investment and future deal-making. Side by side, the trade-off is clear. What you pay, an 18.66 times PE and roughly 8 times book value, looks modest next to what you get. 43% ROE, 14% ROA, and a 28% net margin. In the latest fiscal year, $65 billion in revenue converted to $18.25 billion in net income, a 28.08% net margin, and $7.28 in diluted earnings per share. One honest caveat: gross and operating margin aren't broken out in this dataset. That makes net margin the single cleanest efficiency signal we have here. 5 takeaways to carry forward. Returns that are earned, not manufactured with debt. A valuation that lags earnings power. A balance sheet built for optionality. Net margin as the load-bearing ratio. And a scale where even small margin shifts move billions of dollars. Every figure here is sourced from SEC Edgar, CIK 0000310158, the company Facts API, the Submissions API, and the underlying 10K. Thank you.